Thank you for standing by. Welcome to the Ciena's fiscal third quarter 2022 financial results conference call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press star 11 on your telephone. Please be advised that today's conference is being recorded. I would now like to hand the conference over to your speaker today, Gregg Lampf, Vice President, Investor Relations. Please go ahead.
Thank you, Michelle. Good morning, and welcome to Ciena's fiscal third quarter 2022 results conference call. On the call today is Gary Smith, President and CEO, and Jim Moylan, CFO. Scott McFeely, our Senior Vice President of Global Products and Services, is also with us for Q&A. In addition to this call and the press release, we have posted to the investor section of our website an accompanying investor presentation that reflects this discussion, as well as certain highlighted items from the quarter. Our comments today speak to our recent Q3 performance, our view on the current demand environment and supply chain conditions, as well as discussion of our financial outlook. Today's discussion includes certain adjusted or non-GAAP measures of Ciena's results of operations. A detailed reconciliation of these non-GAAP measures to our GAAP results is included in today's press release. Before turning the call over to Gary, I'll remind you that during this call, we'll be making certain forward-looking statements. Such statements, including our quarterly and annual guidance, discussion of market opportunities, and commentary about supply chain constraints on our business results, are based on current expectations, forecasts, and assumptions regarding the company and its markets, which include risks and uncertainties that could cause actual results to differ materially from the statements discussed today. Assumptions relating to our outlook, whether mentioned on this call or included in the investor presentation that we'll post shortly after, are an important part of such forward-looking statements, and we encourage you to consider them. These statements should be viewed in the context of the risk factors detailed in our most recent 10-K filing and in our upcoming 10-Q filing, which is required to be filed with the SEC by September 8th. We expect to file by that date. Ciena assumes no obligation to update the information discussed in this conference call, whether as a result of new information, future events, or otherwise. As always, we will allow for as much Q&A as possible today, though ask that you limit yourselves to one question and one follow-up. With that, I'll turn it over to Gary.
Thank you, Greg, and good morning, everyone. Today, we reported lower than expected fiscal third quarter financial performance, including revenue of $868 million and adjusted gross margin of 40%. In a moment, I will discuss the specific supply chain challenges that impacted our results and our continued actions to mitigate their effects on our customers and our business. Before doing so, however, I think it's important to understand the context of the current environment as it relates to Ciena, and specifically demand. Despite supply chain challenges and elongated lead times, strong secular demand trends show no signs of abating. And we remain confident that the fundamental macro drivers propelling this demand are durable over the long term. As we all know, these include 5G, cloud, and automation, in addition to infrastructure spending, residential broadband funding, and opportunities to displace Huawei. The combination of these secular drivers and our market leadership, including our technology, investment capacity, and global scale, is driving continued robust demand from customers in both absolute and relative measures. In fact, we had nearly 60% order growth in our last 4 quarters versus the same prior 4-quarter period. In Q3 specifically, orders outpaced revenue by more than 30%, and we continue to grow our backlog, which is now well over $4 billion. And we project further growth in our backlog in Q4. Obviously, as we convert this large backlog to revenue and continue to win new business in a strong demand environment, we have confidence in continuing to gain market share as the supply chain challenges ameliorate. Now let me talk about supply chain. In the face of this strong demand, challenging supply chain conditions persist. I would like to note that at a high level, the majority of our suppliers are delivering to their promised, albeit extended lead times, and we are also starting to see higher volumes. And I think this is sort of consistent with recent market commentary that has pointed to some signs of improvement in the overall supply environment. However, we have recently been challenged by the unpredictable performance of specific vendors and their associated componentry. And when we spoke to you after our second quarter, our outlook for the remainder of the year reflected commitments made to us by our suppliers in early June, which a very small number of them did not meet. Specifically, in the second half of our Q3, we experienced substantial delays and lower than expected component deliveries from this very small group of suppliers. These late notice decommits were primarily for certain integrated circuit components that represent a very small fraction of our overall materials. However, these delays and decommits impede our ability to build and deliver finished goods and systems such as modems for our customers and our ship product for revenue. Put another way, this relatively small number of low-cost, low-value components is holding up a disproportionate amount of revenue, primarily for our optical modems. As a result, our Q3 revenue and adjusted gross margin were both negatively impacted to a significant degree. And to size this for you, but for this specific challenge, we would have been at the high end of our revenue range and in line with consensus gross margin expectations for Q3. I would also say that certain of these supply dynamics have continued into our fiscal fourth quarter and are expected to negatively impact our current quarter's results, which Jim will discuss shortly. We remain very focused on our investments and actions to minimize the impact of these challenges on our customers. Firstly, we are working very closely with this small number of partners to resolve these acute challenges around delivery commitments and volumes. Secondly, we continue to qualify engineering alternatives to expand our sources of supply and to pursue product redesign activities. And thirdly, we continue to invest in our readiness with respect to contract manufacturing capacity, as well as our inventory levels to be prepared when these components do arrive. As a reminder, we also continue to place large advance purchase commitments in their various forms, pay premiums and expedite fees, and access the broker market to secure additional supply. While these actions have obviously been ongoing for a long time and their benefits take time to be fully realized, we believe that we will start to achieve an improvement in volume and predictability with our suppliers as we move into fiscal 2023. At the same time, it's important to stay focused on the investments that we're making in our long-term strategy to further open the aperture of our addressable market. Our portfolio and solutions offerings are at the heart of our customers' network priorities, and our innovation has never been stronger or more competitive than it is today, evidenced by the strong order flows. In optical in Q3, we added 14 new customers for WaveLogic 5 Extreme, and despite the supply challenges, we had a record quarter for WaveLogic 5 shipments, bringing our total WaveLogic 5 Extreme modems shipped to date to more than 44,000. And for WaveLogic 5 Extreme specifically, Q3 was strong with North American Tier 1 service providers as well as web-scale customers. Also in the quarter, we were awarded sole vendor status with a large international Tier 1 service provider for a major network upgrade. I would also say that our switching and routing revenue grew 45%, not all organic, year over year, as we continue to capture additional opportunities and expand our TAM in this important area with our differentiated adaptive IP approach, which is clearly resonating with customers. In Q3, we added 25 new adaptive IP customers, bringing the total to nearly 200, as customers continue to seek alternatives to many traditional legacy IP vendors. Of those new customers, many were wins in key new areas, including 5G XHaul, cell site routing, residential broadband, and in enterprise with the UCPE SD-WAN solutions. Of particular note is the momentum with our universal aggregation and PON solution, where our customer count has grown significantly this year, and we are now expanding globally. Indeed, as you can see in our Q3 results, our routing and switching portfolio has not been impacted to the same extent by supply chain challenges, certainly when compared to our converged packet optical segment. And I think this is consistent with some of the more positive recent commentary from others in the packet IP space. Overall, we have tremendous momentum in the combination of significant secular demand drivers, our leading portfolio, and our TAM expansion opportunities. The business has never been positioned better. As we are increasingly able to service the unprecedented demand, we are confident in our ability to continue to gain share and expand our addressable market. With that, I'll turn it over to Jim.
Thank you, Gary. Good morning, everyone. As Gary mentioned, revenue in Q3 came in at $868 million, reflecting the impact from the late and incomplete delivery of key components by a small number of suppliers. Adjusted gross margin was 40% in Q3, which was at the low end of our range. Overall, gross margin continues to reflect the negative impact of higher component costs and expedite fees. In addition to that dynamic, in Q3, gross margin performance also reflects the specific supply chain in the quarter, as the key components mentioned before are primarily related to our higher margin modem technology. Had it not been for the lack of those key components, revenue would have been approximately $60 million higher in the quarter and at the high end of our outlook range, and adjusted gross margin would have been in line with expectation. Adjusted operating expense in the quarter was $273 million. This is below our expected range. During the quarter, we reduced our accrual rate for our annual incentive compensation plan given our expected financial performance for the year. With respect to profitability measures, in Q3 we delivered adjusted operating margin of 8.5%, adjusted net income of $49 million, and adjusted earnings of 33 cents per share. In addition, in Q3, cash used for operations was $205 million. Free cash flow was a use of $227 million, and adjusted EBITDA was $96 million. We ended the quarter with approximately $1.3 billion in cash and investments. On the balance sheet, our current inventory levels reflect the current demand environment as well as the impact of the supply dynamics Gary mentioned. Since 2021, we have been ordering all of the components and subassemblies required to meet our backlog based upon vendor-published lead times. And other than a handful of vendors, the supply chain is delivering at 90% reliability. Lack of performance by that handful of vendors is preventing delivery to customers. Therefore, we are accumulating components while we wait for delivery of those specific remaining items that are necessary to produce finished goods. We expect our inventory levels to reduce over time as the delivery performance for these key components stabilizes. Finally, in Q3, we repurchased approximately 3.2 million shares for $155 million. We have now completed our goal of repurchasing $500 million in shares in fiscal 2022. With respect to guidance, as we said last quarter, in today's market environment, our revenue is not a function of demand. It is a function of supply. And as Gary said, and we've repeated, we have a very small number of suppliers that are not meeting their commitments or our expectations in terms of delivery times and volumes for a handful of low-cost, low-value parts. These decommits are having a disproportionate impact on our revenue. We saw that in Q3, and we are seeing these dynamics continue in Q4. As a consequence, in Q4, we expect to deliver revenue in a range of $800 to $880 million. This range is lower than previously expected and incorporates a wider set of potential outcomes, reflecting our expectations for a continuation of key component supply challenges in the quarter. Adjusted gross margin of approximately 40%. We expect similar dynamics to impact gross margin in Q4, including lower modem volume and continued higher component costs and logistics expenses. And finally, adjusted OpEx of approximately $315 million. This reflects a return to more normalized levels from the atypical Q3. Q3, as I remind you, was below our original outlook due to the reduction in the accrual rate for our annual incentive compensation plan. Additionally, in Q4, we expect a higher level of variable sales compensation reflecting the extraordinary level of demand we've described. For the year, we will be approximately on the guide we gave at the beginning of the year, absent the changes in our annual incentive compensation plan, which I discussed. As we look to next year, we remain set up well for outsized growth next year and continue to expect to deliver revenue growth significantly above our annual long-term target of 6 to 8%. The strong demand environment and our backlog reinforce our confidence in these expectations for fiscal year 23. And our current revenue expectations for 2023 remain at the level we referenced when we reported Q2 90 days ago. With that, we'll now take questions from the sell-side analysts. Michelle?
As a reminder, to ask a question, you will need to press star 11 on your telephone. Please stand by while we compile the Q&A roster. The first question comes from George Notter with Jefferies. Your line is now open.
Hi, guys. Thanks a lot for the question. I guess just sort of stepping back and looking at the bigger picture here, can you talk about, you know, how you're dealing with these issues in terms of customer conversations? You know, I guess one thing I'm curious about is just on a relative basis, it seems like you guys are doing worse vis-a-vis your competition in terms of deliveries here. And, you know, I'm kind of wondering, you know, is this going to impact, you know, long-term market share, long-term opportunity for Ciena? Like, how permanent do you think the damage is here in terms of, you know, your customer relationships?
So, George, let me take that. I mean, I think, listen, we've got very close relationships with all of our customers, many of which go back, some of which go back decades. So I think we have, you know, strong degrees of trust and transparency with them. And, you know, we can only talk about what we see in terms of the challenges from a supply chain point of view and the difficulties that we're encountering now, but we've been very transparent with them. You know, and I think the best way of sort of answering that in sort of summary, George, is really we're continuing to see very robust orders. You know, we've not seen cancellations. We've seen, you know, orders continue to well outstrip revenue, and the statistic that I kind of shared about 60%, year-on-year order growth for the last 4 quarters, that's sort of testament to it. And they understand the challenges that we're having. But I think because of our technology and our relationships, we believe that when all of the smoke clears from all of this and begins to ameliorate, that we will actually gain share given the outsized demand that we see.
Got it.
And on the vendor side, I was going to comment on the vendor side, George. On the vendor side, I can tell you that we do see some improvement on most components. In fact, for the majority of our vendors, or for everyone except these key components that we're talking about, we're seeing about a 90% deliverability performance against promised lead time, which is pretty good. So we're focused, of course, on this very small number, less than a handful of vendors that are not delivering. In fact, they've been quite unreliable and have caused us great difficulty. We're dealing with them appropriately at all levels of the company. We're hoping that performance improves as we move through time. Then in the meantime, we're taking a lot of steps to deal with it in case it doesn't, such as re-specify parts on our boards, et cetera.
Yeah, that's what I wanted to ask about. So, where are you in the process of redesigning these components out? How many components specifically are we talking about? When might those redesigns be done? Just give us any more detail there. That would be great.
Yeah, George, it's Scott. So just in terms of dimensioning it, Jim said the vast majority of the supply chain is pretty much delivering to their promises. We're talking about a very focused set of components here, and to put it in perspective, when we say that, it's a couple of handfuls of component parts on a handful of vendors. Obviously, we have a significant amount of redesign work going on as a vehicle to get at those problem components, in addition to working with the existing component suppliers to get a better answer out of them as well. On the design side, George, they fall into 2 categories. One is a sourcing exercise where you may be able to find alternative components that are plug replaceable. In that case, you still have to get in line to lead times from those component providers, but it's a less of a heavy lift on our side. The second category, of course, is where you need to redesign in order to take advantage of those component parts, and those are hardware redesigns, and those are multi-quarter activities. All of that activity, I think, starts to come on board in 2023, and we'll start to see a gradual benefit from that as we go throughout the year, in addition to continuing to work with the existing component suppliers.
And to be clear, again, this handful of suppliers has been very reliable in the past. This is a new phenomenon. Of course, we're in unusual times. But when we have spoken to guidance in past quarters, we have always based our expectations of revenue upon their published lead times and the fact that they have met those lead times in the past. So that's how we came up with our view of the world, and that's why we've guided where we have.
Yeah.
Okay. Thank you.
And a number of those vendors, George, they supply multiple parts to us, and in many cases, many of their parts are performing as they promised. This is a very focused subset.
Okay. Thank you, guys.
Please stand by for our next question. Our next question comes from Meta Marshall with Morgan Stanley. Look, your line is now open.
Great. Maybe just kind of jumping on George's question, is there a way to size kind of the impact of products already redesigned, so we can just get a sense that, given that we're a year through this, that you've already redesigned and that's made X number of revenue available, just to kind of balance out some of the downdrafts that we're seeing. And the second piece would be, just as you kind of continue to express confidence in fiscal 23, I mean, what are you basing kind of that confidence on, would be helpful. Thanks.
Why don't I answer that second part first, Meta? We're basing that confidence on, first of all, incredible visibility and backlog. So that's number one. Number two, the actions that we've taken, which are multifaceted, and we tried to get out ahead of this. This is not a reactive piece. I mean, we've talked about this for a while. We knew that demand was going to increase substantially this year, and we planned, as we shared with you, for a double-digit growth this year, and we took a lot what we thought were the right, supply chain actions in place for that, in terms of placing orders, in terms of actually engineering work to reduce our dependency. Those things start, I think, to kick in as we come out of this year into 23. And, whilst we're cautious, given the impact that we're seeing both in Q3 and Q4, we believe that they will ameliorate from the actions that we've taken and the work that our partners are doing also to ameliorate the issues. So, we have very good confidence as we turn the year that this will start to improve. It won't be an on-off switch. It will be, a process that improves as we start in Q1, but it does give us confidence, in the year that we grow out of this.
And maybe, Matt, just to give you some sizing on the activities. If you look at our total component bill of materials, if you like, for the entire portfolio, we've had multi-sourcing activities, in other words, qualifying alternative parts that adds about 10% to our approved vendor list, obviously focused on the challenge areas. The timing challenge with that, of course, is when you identify a new component, you get their new orders and you get in line on their lead time. So, those activities were ongoing throughout 2022. The lead times in the industry would suggest that those are going to start to come and have an impact on our ability, a wider aperture, if you like, for the supply components in 23. On the redesign side, we've got multiple tens of redesign activities on the go right now, which is probably about 10 times more than we would have in a normal year. All of those are in front of us. Those are all 2023 impacts, because they really are hardware redesigns. So they will help in 23 as well. And maybe to put another way to look at it, if those problems didn't exist on that very small handful of components, we would have had revenue in the range of our original yearly guide, and then some, just on alleviating those small number of components.
Thanks.
Hopefully that helps to mention it for you.
Yep.
Thank you, Meta.